Okay, we're just going to finish off the interest on mortgage. So we know that we should have paid $3,600. Having a look at interest on mortgage, it says that we've only paid $3,300, so we need to increase that by $300. So this is going to be an accrued expense because we still owe it. Okay. So therefore, our journal entry is going to be 31 March. We need to increase interest on mortgage, so it's going to be the debit because it's an expense of 300. And our credit is going to be accrued expenses because it's a liability, current liability, and we still owe that. So that's going to be 300. Right, and so we're going to add to our accrued expenses. So instead of being at 1,000, it's going to be 1,300 now. Right, now we're up to all the different types of depreciation. Okay, so remember with our depreciation, you've got three types. You've got diminishing value, straight line, and units of use. So make sure you look up in the module. So module 1 will cover the different types of depreciation. And again, the best way to get familiar with them is to do lots of practice. In this one, we've got depreciation on delivery vehicles is 20% per annum on diminishing value. So that means that for our depreciation on vehicle, we need to get the carrying amount. So we're going to find the historical cost for delivery vehicles for our trial balance, and it is 70,000, and we'll find that on the debit side. Then we're going to find the accumulated depreciation and take it away. So that's 30,000. And we're going to times that by the rate that we're given, which is 20%. Okay, so it's going to be 70,000 minus 30,000. 40,000 times by 0.2. So our depreciation on delivery on the vehicles is 8,000. So we need to create, so our journal entry is going to look like this. We're just going to add in a few more lines. Okay, so we're going to create the expense depreciation on delivery vehicle, which is a debit. And it is for, what did we work it out to be? 8,000. So that's the debit. And then we're going to credit accumulated depreciation. And for the exam, make sure you use complete account names. Don't abbreviate them. You have to write out the whole thing, just as they are in the trial balance. So on our trial balance, we would create a new expense called depreciation on delivery vehicle. And that would be 8,000, and we'll add 8,000 to this, so we'll get 38,000 for our accumulated depreciation. Right, now we're going to do the same thing, but this time it's straight line for our warehouse equipment. So straight line is just going to be our historical cost for warehouse equipment, 90,000. If they give you a residual value, you would take that off. They may give you a a residual cost and how long, and so then you could work out the rate for a straight line. So we're just going to find our straight line value. So it's going to be 90,000 times by 10%. So just 90,000 times by 10%, which will give us 9,000. Okay, and we're going to do the same down here. But so we're going to have depreciation on warehouse equipment, 9,000, and accumulated depreciation is going to increase this by 50 up to 59,000. And our journal entry would be exactly the same as the one we've done here, except it would be debit depreciation on warehouse equipment, credit accumulated depreciation on warehouse equipment. The last two items are things that are going to go in our PPE. So what we've done now is we've covered all the general journal entries that you could do for balance day adjustments. Now, the other general journal entries that you need to know about are the closing ones. So only income and expenses get closed off to the income summary. So we'll just do an example of what that would look like. So if we had, let's do our accountancy fee. So we're going to close that off to income summary. So it's going to be debit income summary, credit accountancy fee. And we just got to go back and check how much it was. 15,000. Okay, so this is the closing entry for expenses. Okay. And so therefore, it's always going to be debit the income summary account, credit the expense, whatever its name is. If we were going to close off our income accounts, we'd go, let's close off sales of 790,000. So it's going to be debit sales to close it off and credit to income summary. 790,000. 790,000. There are only two other closing entries you need to know about, and they relate to the owner of the business. So we need to close off the profit and loss for the year to income summary, and we're going to close off drawings. So if we are in profit, we would debit income summary and credit capital. If we were a loss, we would be debit capital, credit income summary. Okay, and so that would be for a loss. Now, you'll either be given the profit or loss, or it is the final figure in your income statement. Okay, so probably if you were going to do these ones, they probably would give it to you rather than relying on you calculating it. Now, the only last thing you've got to be able to close off is your drawings. So it's going to be a debit to capital and a credit to drawings. And drawings are the money that the owner's taken out during the year. So our drawings amount is 59,000. Okay, so these videos have shown you how to deal with all the different types of balance day adjustments as journal entries, and how to do the closing entries as journal entries. The next video we're going to look at doing the ledger accounts. Now the only balance day adjustment